The balance sheet is a snapshot of certain key facts about your business on a specific date. So where the income statement was over a period, let's say a year, the balance sheet is as a specific date. So for this past year, you would have an income statement for 2021, and your balance sheet would be at December 31st, 2021. And then in terms of an investor looking at your balance sheet, they'll notice that a strong balance sheet has smaller liabilities as compared to equity, and a weak balance sheet has high liabilities compared to equity. Similarly, a strong balance sheet has higher assets compared to liabilities. So these are just ways of saying, you know, how are your assets and liabilities weighted against each other? It does not tell you if you made money last year, and it does not tell you where the cash came from and if it's a healthy cash flow business. Actually, what an income statement is, it sounds simple. It shows you how much income you've made or profit. It's over a certain period of time. So generally speaking, an income statement will be either for a period of a quarter, a month, or a year. When you run your income statement in QuickBooks or Xero or whatever platform you use, you can choose the period of time, but it will show over a period of time if your company was profitable. And then but what it doesn't tell you is how much cash you have to spend. So it's interesting because you can appear profitable on paper, but you may have no cash in the bank, or vice versa. You may be generating massive losses because you're investing heavily, but you could have, you know, we spoke to a client on Monday that has $25 million in the bank, but they're forecast to lose money for the next 4 years. But that's okay because they have enough money to fund all those losses for the next 4 years when they start generating income. So a cash flow statement tells you how much cash flowed into your bank account and how much flowed out. So it's the cash in and the cash out. This arguably for you is the most important thing to keep track of, is how much cash you have coming in versus how much cash you have going out. You might be profitable on your income statement, but if you don't have enough cash on hand, you can't fund your business. So this is the one statement that you can't do without.